Hello, everyone. This is Alex Creech with the Creech Crew, and I am joined today by Cheryl Grass. We're going to ask her some questions about some unconventional ways to get loans for purchasing a home. So let's get right into it. Let, let's just go ahead and talk, Cheryl.
Yeah.
Talk about this. So you got your normal conventional loan, you got FHA, you got VA.
And
What about
USDA.
USDA?
Mhm.
Sure, that's more for like agricultural, right?
Yep.
What about for folks that's not exactly the right fit for them? What else is out there?
They don't fit into that bucket. So there's qualified mortgages, which are basically less riskier mortgages. They follow the Dodd-Frank Act and the Consumer Financial Protection Bureau guidelines. When you have riskier scenarios, whether it's income or investment, things like that, they have what's called non-qualified mortgages.
Okay.
They've become more popular as people are buying more investment homes, or they a lot more with COVID. A lot of people have become self-employed, so they don't fit the income requirements. So basically, there's two that we're going to talk about today that are the ones I see more of, the more popular.
Okay.
One is called a bank statement loan, and the other is called a DSCR loan.
Okay. And so for each of these, we'll talk about each one. We'll find out, who qualifies, who benefits from it, and how they can use that type of loan to buy a home. So first one you mentioned was bank statement loans.
So these are more for people that are self-employed and they make a good income, but their tax returns show otherwise.
Okay.
So people that have businesses that they make pretty decent money, but they have a lot of deductions from their businesses, and it just doesn't show on their tax returns. So bank statement loans basically take 12 to 24 months of bank statements, whether it's personal or business, wherever the money's coming in, and they will determine your income that way.
Okay.
So you still have to meet minimum credit requirements. It's usually a 660 credit score.
Okay.
They do require usually a more of a down payment, and the interest rates are slightly higher.
When you say more of a down payment, are we talking 10%, 15%?
Some have 10% as a minimum, but most of the lenders require 20%. And if
Really?
you can do 25%, you get better pricing.
Okay, so yeah. 20 to 25. And this one strikes me as very beneficial to someone like myself. Like Amanda and I, we're in real estate full time, so we have we make the non-taxable money, but then we also have a lot of deductions, like you were talking about.
Yes,
so
I do as
I
well.
could see,
So
I could see, yeah, I could see it's benefiting you too. Do you see? Is there overwhelming couple of occupations that you see that are high percentage using this loan?
I mean,
or is it just across the board?
It's just across the board, self-employed folks that I'll have people that will just send me their tax returns, and we pretty much can tell from their tax returns if they will qualify or not. Okay. The only guideline really that people should know is you should be in business for at least a year.
Okay.
And own at least 25% of your business.
Okay. Okay, gotcha for that. All right. And
it's also good for people that it's also good for people that work in the tip industry.
Oh, okay.
So bartenders, waitresses, massage therapists, things like that.
Understood. And you talked about the rate being slightly higher. How high did you say again?
Right now, I actually just closed one about 2 weeks ago, and it was 8.75. So in the 8 to 9 range.
Okay, 8.75. And do you know what conventional was at that point?
A lot of factors, but right now they're in the high 6s, low 7s.
Okay, so it's almost a solid 2 points higher, but it's at least an option.
Yes.
It's an avenue for folks if they don't have any other avenue.
Correct.
To getting a home. For the other loan, what was the other one called?
DSCR, it stands for Debt Service Coverage Ratio.
Okay.
It's great for investors. So a lot of investors, they have, their primary home or maybe even a second home. Well, then when they go to buy an investment home, their debt to income ratio won't allow it, or there's another guideline that they're not meeting.
Okay.
So they're not able to get another home for various reasons. This loan, you actually, debt to income ratio is not a factor.
Okay.
They basically take the rental income of the home and compare it to what the mortgage payment will be. And as long as it meets a certain ratio, then you can get the loan.
And this is a rental home that they already own, or is this the rental home that they're looking to buy?
Either one. So you can do a DSCR it's called a refinance if you already own the home.
Okay.
But if for
A
a new home,
DSCR refi. Okay, if
exactly.
you already own it, and
There's
then that's going
cash
to use
out
the rental income.
options too.
Oh, cash out options too. Okay,
Yes.
I could see that being especially beneficial for investors who want to go ahead and put that money into the next investment property. All right, so for this example, let's say it's one that they're purchasing. So they're looking at who runs the comps then, who's running the rental comps.
There is an appraisal for this.
Really?
Yes.
Okay, and it'll give you a rental amount appraisal comp.
Correct.
And then that's what they're going to base your loan amount on.
Correct.
Okay.
Yeah.
So
that's what they'll base the ratio on.
The ratio.
Yes.
Okay. Got you. So
Yes.
could you give us example for numbers for that? Like if rent was like 2,000?
So you want to stay within, usually it's around a 1% ratio that they want to stay around.
Okay.
For that.
Oh, okay.
Yeah.
So if the home costs $200,000 and then the rent's 2,000, everything looks golden.
Yes.
Okay. That's also an investment trick too for investors to look at the 1% rule for rent, which is getting harder and harder to come by here in Jacksonville, Florida, as the home values have appreciated. Yeah. Okay, so 1% rule is what they're looking for. And is there any other requirements or?
Typically, it's 20% down.
20% down
for these.
Okay.
And of course, minimum credit requirements as well. Usually around a 660 is for most lenders, that's the minimum credit score.
Okay, so very similar to the bank statement loans. Yes. However, just the way that we get there is a lot different.
And it is, like you mentioned before, it is helpful if you already own an investment property. If you want to do a cash out, you can take those funds and turn around and put it towards.
You could probably make that be the 20% down.
Yes. For the next investment property.
Okay.
Just did one of those.
Did you? Is there anything else that we need to know about DSCR loans?
No. And there's other non-qualified mortgages. These are just the two that we've been seeing more lately. So if you have questions about a certain scenario, feel free to reach out and we'll see what we can do.
Okay. So for those of you who just thought conventional or FHA was the only way to go, we have a couple of other options out here in Jacksonville, Florida that Cheryl could help you with. So thank you, Cheryl, for being here.
Alex.
This is Cheryl Grass, Forever Home Loans, and I'm Alex Creech with the Creech Crew, closing deals in cleats.